Hi, everybody. Welcome to our program today. I'm Michelle Weiss, Chair of the Tax Section and Tax Controversy Attorney at Holt, Slavitt and Drabkin. I'm glad you're joining us today. As you saw, there was a video about the different levels of Beverly Hills Bar membership. Different levels work for different people. And I hope that you find a level that works for you. And if you're not yet a member, I hope you'll join us for this and other wonderful programs that we have. I also want to thank our sponsor for the tax section, the firm of Hockman, Salkin, Tasha, and Perez. They have staunch supporter of the tax section, and we appreciate what they do for us. So I want to start the program today with our esteemed panel of tax scholars, Annette, Nellen, and David Schizer. Annette Nellen is a tax professor at San Jose State University, where she directs the graduate program. She is the past chair of the ECBA Tax Executive Committee and an active member of the ABA and California Lawyers Association Tax Section. Her research focuses on how to reform tax systems to follow principles of good tax policy and reflect how we live and do business today. David Schizer is a tax expert at Columbia Law School, where he served as dean for 10 years from 2004 to 2014. In 2017, he took a leave from the university to serve as the CEO of the JDC, the Joint Distribution Committee, an international humanitarian organization, and returned to the law school a year ago to continue his work in tax law. At the beginning of his career, David served as a law clerk to Justice Ruth Bader Ginsburg in 1994 during her second year on the Supreme Court. So thank you, panelists, for joining us and for zooming into Beverly Hills from other places. We really appreciate your time here. And I just want to give a brief overview. We're going to be chatting about tax policy under the Biden administration. First, there'll be a discussion about the process and the context and how the legislation is or isn't passed. Then we'll talk about specific legislation items, including revenue raisers, and then moving on to tax expenditures and seeing how things in place may or may not change or stay the same under the new administration. So Annette, let's start with what tax changes are set to occur over the next few years, even without tax legislation.
All right. Thank you, Michelle. Welcome, everybody. Thanks for having me. I don't think it gets a lot of attention, but the Tax Cuts and Jobs Act, as well as just the long list of provisions that continue to expire over, like, I think for the next 10 years that are built into the law, there are tax increases that are already going to happen if nothing happens. And I know certainly with the Tax Cuts and Jobs Act, probably our first thought is, oh yeah, the individual rate cuts and the higher standard deduction and the higher child credit, they all expire after 2025, as does the 199 cap A deduction. But there are others built in there as well. For example, starting for taxes beginning after 2021, we will no longer be deducting R&D as it occurs, which we've been doing since 1954. Instead, we'll be capitalizing it and writing it off over a 5-year period or 15 years for foreign research. That's a major tax increase there, which actually I don't expect anybody really wants to see that one happen, but with no action, it will just happen. It's built into the law. The 163J interest expense limitation will become a less favorable calculation, meaning more of it will be limited. That's built in. 100% bonus depreciation is set to phase down. There'll be changes to the rates for FDII and GILTI, and that's just going to happen. Now, there were also changes where there were a couple of provisions put in for only 2 years. For example, there was a new credit for family medical leave under 45S, only there for 2 years. That just popped into the Consolidated Appropriations Act, signed into law at the end of last year, to get another 5-year life. No discussion that I'm aware of, just went in for another 5 years. Plus, there were various provisions regarding special rules, such as a lower excise tax rate, also pulling them out of interest capitalization for beer, wine, and distilled spirits. Those items were just made permanent by the Consolidated Appropriations Act. No discussion that I'm aware of, but you would think there should be, and we're talking about tax policy in the Biden administration. One thing I keep on raising, when will we have a tax policy discussion? Did those make sense to become permanent provisions? Why were they only put in for 2 years at the start? And why focus on those industries, for example, that they don't have to capitalize interest expense? Because what they did at the Tax Cuts and Jobs Act was to say, while they're aging in the barrel, like the red wine and the distilled spirits, that's not counted as part of the production period. So likely the production period won't be more than 2 years, and they won't capitalize interest. They'll instead take it as a current deduction. But when these changes are made, like that one becoming permanent with the Tax Cuts and Jobs Act, when we're also thinking about, well, aren't we looking for where do we have any money that we might be able to help stimulate the economy now? Why were the dollars spent on making those permanent? We'll come back to that with the discussion of tax expenditures. But just to be aware, there are Tax Cuts and Jobs Act items become permanent. And when you look at the list of expiring provisions, which the Joint Committee report issues a report every January listing them all, in 2022, and 2023, there's significant highway trust fund excise taxes and airport and airway trust fund taxes that are set to expire, which I don't think anybody wants them to expire. It'll take legislation to continue those. So there's many things that do have to be looked at because they're on automatic, like autopilot to just happen.
If the Biden administration does want to make some changes, what is the process that they need to go through, and what hurdles do they have? How would the process work? Now we know the Democrats do have a majority in the House and the Senate, almost. So how will that happen?
So they have what really is mathematically the minimal majority in the Senate. It's 51-50 with the vice president breaking a tie. So a couple of things to observe. The first is, if you were relying on the Senate Finance Committee to consider legislation and then refer it, they're divided 13-13. But on the other hand, part of the power sharing agreement that they struck was to do what they'd done in 2001. A tie means that you can go out to the floor. So this means the Democrats can refer legislation out if they hold all of their members. Another thing to notice, Elizabeth Warren was added to the Senate Finance Committee yesterday. That's interesting. She's certainly been at the progressive edge of the party, pushing things like wealth taxes, which I think are unconstitutional, but in any event, her presence on the committee is interesting. On the other hand, the truth is I don't really expect the Finance Committee to play as big a role as you might expect. Why is that? They're not going to go through the path of regular legislation. The filibuster would block that. Instead, the route they have is reconciliation. And that is a special procedure that was used by President Bush to pass tax cuts back in his presidency. The TCJA used it, the Affordable Care Act used it. But the key there is it can't be filibustered. You get 20 hours of debate and then another 10, and then it's over. So it's filibuster proof. You can do legislation 51-50, but it does have some parameters. This can only be about spending and debt ceilings and revenue, which means you can get tax in there, but only certain kinds of tax legislation. And the House and the Senate would need a resolution, and then they'd give directions probably to the Budget Committee to figure out how to reconcile, which again means it's probably not the Senate Finance Committee doing the heavy lifting, although we don't really know. One thing to observe is they are going to need 51 votes, can't have any defections, which means Senator Manchin, for example, has to agree with whatever the final package is. He's expressed some views already, which aren't exactly the same as what's in the Biden campaign materials. Two more things. First of all, you get one of these a year. So in principle, they could only do one, but because there wasn't one for the last fiscal year, they may be able to use that. And it looks like as of the last day or so, they're planning to use that for the COVID bill. They've just initiated reconciliation for that, but they could still use reconciliation later this year to get through some sort of tax legislation. And there, it's important to note, there's this thing called the Byrd Rule. You can use what's called a point of order to object to something that's considered extraneous. Well, what does extraneous mean? Two things. One, you can't increase the deficit outside the 10-year window. So when Annette was mentioning all these expiring provisions, the reason those provisions expired was to be able to use reconciliation last time. And the second thing to note is there is an explicit bar against any changes in Social Security. So the campaign materials from President Biden said that he wanted to raise almost a third of his revenue from adding a 6.2%, well, 12.4% tax, 6.2 to the employee, 6.2 to the employer, on people earning 400,000 or more, meaning the Social Security tax would no longer phase out for them. It would start again. You cannot do that with reconciliation. It would be vetoed under the Byrd Rule.
So did you want to talk about if there are regulatory freezes, Annette, and Trump proposals that were not yet finalized?
Yes. With a change in administration, we often see that certain, usually kind of year-end kind of lame duck session regs that we're going through from the last administration might get held up. And Biden already did issue an executive order the day he was signed into office, along with many others, that was causing them to be looking at something that maybe was sent to Federal Register, but has not yet been published. So they're looking at those. But beyond that, there'd also be other ones. I mean, for the IRS, it's not unusual for them to be issuing a notice. Future regs will provide, and here's the interim rules. Well, those interim rules certainly could still change. One I'll note was a notice 2020-75 that was saying pass-through entities, partnerships, S-corps, if you have a state level income tax imposed on you, even if it's optional, and even though it's going to still require that the owners have to report their share of income on their federal income tax return, if the state's making them or suggesting they can pay a state level income tax, we will treat that as a tax directly imposed on the partnership, taking it out of the $10,000 SALT cap. Well, I'm probably not alone in questioning the substance over form benefit of that. Is that something the current administration would say, oh yeah, get working on those regs, keep working on those? Now, the Democrats don't, for the vocal ones seem to not support the SALT cap that was in the Tax Cuts and Jobs Act. But I know when they look at the dollars distribution of repealing it, yes, like any deduction, is going to be more beneficial to the very high income individuals. And of course, for lower income, they also still have an individual AMT, which is going to capture them claiming a full SALT deduction anyway, but that won't be true for higher income. But that'd be one where might we just see a policy discussion? What should it look like? Because if they do go forward with these regs as planned from the Trump administration Treasury Department, that doesn't do anything for sole proprietors, doesn't do anything for very high income wage earners who can't deduct all of their state income taxes they pay. It's just this isolated benefit that states, including California, already has a proposal to put that in place. States will spend a lot of effort to put these rules in place. And is that the way to go? So I think we're also looking at notices, areas where we might want some more administrative guidance. What might happen to those when you have a change in administration? So certainly be watchful for all those things that aren't final regs yet.
Right. And then, David, did you want to discuss also if legislation does pass, can it be retroactive to January 1st, 2021, or does it have an effective date going forward, or how do you see that will work?
So, Michelle, I think the way you started the question, if there will be legislation, is important. We've already talked about how it's a bit of a knife's edge to get something enacted. But on the other hand, there's a pretty good chance I think they'll try, and a decent chance they'll get some legislation. So what'll the effective date be? Well, let's start with ruling out the Constitution as any kind of constraint here. It's pretty clear under cases that Congress can make the effective date. If they pass in December, they can certainly bring it back to January 1. There's even support for the idea of going back a bit further than that. For example, if they pass, March of next year, they could presumably go back and so on. But I think the real constraints are political. What are they going to feel comfortable doing? How do they get that 51 or 50, I should say 50 Senate block to hold? And there are a couple of aspects to that. One is, I'd say, I see a difference depending on whether they get to this in March, whether they get to this in December. And at the moment, they seem pretty busy with the COVID bill, impeachment, and other things, confirming cabinet officials and so on. So it doesn't look like they're on the fast track to do something with tax rates. To the extent you're talking about an October bill, going back to January 1 on some issues might not play well. And that brings me to the second, not only timing, but also what we're talking about. So if, for example, Senator Schumer wants to deliver a higher SALT cap and they get to that in November, I think there's a good chance that that would be retroactive for the whole year. They could say they were doing it only as of next year, but it wouldn't shock me. On the other hand, if you're talking about a new higher capital gains rate, going back to realizations on January 2nd, when the provision is proposed in September, that's a more aggressive thing to do. Doesn't mean they wouldn't do it. They could, but I think politically it may be less likely.
Yeah, I mean, it's just interesting to note. I mean, there's a Democratic majority, but really every single Senate vote counts. So it's interesting because there almost does need to be some bipartisanship to some extent in case there's a Democrat falling off in the other way. And yeah, I have seen things. Also, I know Elizabeth Warren has been talking about the net wealth tax again. So that's certainly in the news and something we need to think about. But looking at revenue raisers and the way that things will go, Annette, did you want to discuss what could happen with individual tax rates over the next couple of years?
We've probably all heard in campaigning that President Biden had commented that nobody under $400,000 of income would be paying more tax. And personally, I was kind of dismayed to hear that because he also talked about increasing the corporate tax. And I don't know if all economists agree on, but probably a majority of economists agree on that some portion of the corporate tax is paid by employees, customers, and investors. And of course, if we're talking about people making more than $400,000, we're talking about roughly less than 1% of the population he's looking to have a tax increase on. But I encourage all of you, if you've never looked at data as to what income levels are in the top 1%, the top, 1/10 of that, 1/100th of that, you need to look at it. It is just shocking to see the wide range. I mean, if someone is in the top 1%, I make $400,000 in the top 1%, but you're in there along with people making $400 million a year. Do you want the same tax policies for you as opposed to the person making $400 million a year? So that certainly needs to be looked at. But, also he's talking about like climate change. Our gas tax is actually still 18.4 cents per gallon that it was in 1993. And if we're all supposed to be involved in helping with deal with climate change, wouldn't you want to increase that? So he has said, he doesn't want to have that tax increase for those under 400,000, but I think it's going to be like the first President Bush, who had said no new taxes, but did increase the individual rate to 31%, plus increase the gasoline excise tax. But specifically, what Biden's looking at, and he has looked at the data. He knows that top 1%, when you get to the folks above 400,000 and you get to the folks that make 400 million a year, there's a lot of revenue potential there. So he's looking at things such as, let's bump the top rate up to 39.6. Now, is that going to be a top priority when it's automatically going to be that back in, when we get to 2026, it'll automatically be that? Who knows? He also is talking about cutting back some benefits for the higher income, including capital gains rate being the top 39.6 rate once your income's more than $1 million. Now, people say, does he mean once it's above $1 million, it's only about $1 million, or to be, you got $1.1 million and all your capital gains are taxed? I think he means probably more than $1 million. then you're going to be not at a 20% rate, you're going to be at a 39.6. Capping the benefit of itemized deductions where the benefit's no more than 28%, even though your rate is higher. That's actually something had been in the revenue estimates for proposals for the Obama administration. It does talk about, and I'll save some of this for David about some of the, like, the step on basis of death, any reference to any kind of a wealth tax there. Plus, he's also campaigned, well, we want to give some benefits to the folks below the 400,000 level. Let's increase the child credit. Let's increase the refundable part of the child credit. Let's provide some relief to those who are providing care for other family members. But so far as the revenue increases for individuals, it is looking at that above the 400,000, bumping up the top rate. As David mentioned, trying to get the Social Security restored once your earned income is above 400,000, and looking at taxing capital gains of high income individuals at a higher rate. And it really is a lot of revenue because there's a lot of dollars at that amounts above 400,000.
Yeah, well, the other thing also is a very tiny percentage increase can be a large amount of money. You don't need to have a large percentage. So
right. When you think, the median income in the country is roughly 55 to 60,000, and many of those are wage earners, so they're already paying, their regular income tax. Looking at the employer-employee share of payroll tax, they're paying 15.3. You can't really get much more out of them. If you instead look at someone making, $300 million a year, mostly from capital gains, if you increase that capital gains rate from 20% plus the 3.8 net investment income tax to something higher, there's a tremendous amount of revenue there. So that's why it's looked at. And this is not I mean, Congressman Camp knew the same thing when he came up with his reform proposal back in 2014. He had first talked about we'll have two rates, but no, we looked at the proposal, and he was chair of the House Ways and Means Committee. There was a surtax because I think he realized we'll never get the revenue if we don't put this additional tax on the very high income.
So I have to say, though, I think the idea that you can raise that much money from the top 0.1%, I think it's just not the case. I mean, you really have to go broader than that. And I would say if you're earning $400,000 living in LA, do you really feel like you're flush? I suspect you probably don't. But maybe we can get a little bit more specific about, Annette, the list that you gave us, which was, of course, the right list. So 39.6%, that's what the top rate was before. But of course, it doesn't include the 2.35% Medicare tax. So really, the top rate is 42%. And, that's going to happen. I think certainly automatically, they could easily accelerate that. But then remember the Pease rule, which you referred to. That's really a tax increase in disguise. What it basically says is that if your income is above, in this case, $400,000, you lose itemized deductions equal to 3% of 3 cents on every dollar that you earn above 400,000. They could have written it as a tax increase. That would be 1.2%. They thought it was maybe politically easier to do it obliquely, but that brings your federal rate to 43.2%. Now let's add the 13.3% in California, and now you're at 56.5. What I haven't done is add that 6.2% Social Security tax that the president has also proposed. Can't get it through reconciliation. He could do it just as a tax. Don't call it a Social Security tax. You could do that in reconciliation. Then all of a sudden, the federal tax is 55.6% on that last dollar. And California, you're up to 69%. Pretty high rate for the 400, if you're earning $400,001.
Yeah.
Right.
So and the reality of the situation is that it causes people to do aggressive planning, and then what happens is the people that and this may be outside of our discussion, but just speaking as a tax attorney and having worked at the IRS, it just causes people to come up with some really creative ways to avoid it. And so the question is, are you really accomplishing your mission? I'm not sure about it, but
and Michelle,
better ways to go.
Yeah. And if I can add something we only touched on briefly, capital gains, right? So if you think about what people can do to avoid the capital gains tax, it's pretty significant. So right now it's 20% plus the 3.8% net investment income tax. So it's really a 23.8% rate. If they really brought it up to 39.6%, and by the way, in theory, they'd be including that 3.8% tax, so you'd actually be even higher than that. Then what you'd have is a lot of people entering into costless collars or prepaid forwards. Like, they're not going to sell big positions; they're going to find ways not to. And there, there's been a lot of research suggesting that the revenue maximizing rate shouldn't really be above 28%. Maybe it's 30% now, who knows? So honestly, I don't really think they're going to try to go all the way to 39.6, let alone 43 or whatever that is. But you wouldn't get the revenue that in theory you think you're going to get if you tried to raise the rate that high. And
what about the wealth tax? Do you think that has any prospect of passing?
So, Annette, I'm interested in what you think. I would say just you kind of go back to the old Pollock case and the reason we needed a constitutional amendment to pass the income tax. That Pollock case would absolutely be an easy site to strike down something that really is a wealth tax. Now, you can call something a wealth tax and it's really a different kind of an income tax, and that, you could do. But it strikes me that given the difficulty of getting tax legislation through and a reconciliation bill and all the rest, it would be a chancy thing for the administration to invest a lot in something the court could easily strike down.
Yeah, I agree. I think the focus on the wealth tax, we are not there yet. There are so many policy improvements that are needed to the income tax. That's where we should start. And we will get into discussion about tax expenditures. We're talking about trying to get more revenue. We shouldn't be looking solely at the rate. I mean, yes, we should look at the rate and what's the progressive rate structure given the varying income levels today. But you really need to look at the 100 plus special rules that are in our income tax system that also provide great benefit primarily to the higher income. Could those be reduced or even better distributed among more individuals? But to look at a wealth tax and then even get into discussion, what boggles my mind is, Warren's got a proposal. I think it's 30 million 30 million means you're wealthy. Sanders, it's like 50 million. California had one with some modifications, 30 million. In New York, you have to have $1 billion before you're considered wealthy. These are sort of, I hate to say, ludicrous discussions of what is wealth? I mean, you're only wealthy if you have $1 billion versus you only have $500 million. I mean, what is going on here when we're talking about a minute fraction of the top 1% here? Can we be looking at something, more productive and not have some notion that our current other systems are so perfect you can't fix them in any way? We just have to have a new tax. We have more discussions, and for something to possibly end up in the judicial system for years, I don't see the point of that. We're not near to that level of needing revenues. Let's fix the current systems.
Okay, so for both of you, Larry May, who's one of our attendees today, asked a question: what about a tiny tax on stock trades that some propose can raise significant dollars?
So I will say for myself, the first question you want to ask is, do we think we want more stock trading or less stock trading? And I think the usual answer I would give, putting aside some of the chaos in the markets in the last month, is that stock trades are good because they help the stock price become more accurate, and you don't necessarily want to interfere with that. So I'm not sort of viscerally in favor of that. A lot of things you could do to raise revenue, but if you're going to mess up the accuracy of stock prices, it's probably not the way to go. I actually have 3 other things that I would suggest to think about. But Annette, did you want to weigh in on the stock trade point?
No, I agree. It is an example, though, of, can't we just have some tiny tax that's not really noticeable and it'll generate a lot of revenue? Well, there's other things we could do to fix current flaws in the income tax that would also provide some revenues. I don't think we're there yet.
So in that spirit, one thing Ron Wyden, who's the new chair of the Finance Committee, has proposed before is mark-to-market taxation for publicly traded securities. And the idea is, end of the year, you compare the price to the beginning of the year. If it's gone up, you pay a tax. If it's gone down, you get a deduction. This would be a way to collect a lot of revenue from very, successful, from the Bill Gateses of the world, people with big publicly traded stock positions, and it would eliminate those issues we talked about where people would delay selling, even if they wanted to sell. You wouldn't need a high rate. I mean, you could keep the rate as it is and collect a lot of revenue doing that. So that would be one. The second, which the president has proposed, is a step up in basis of death, so that you don't have that anymore. This way, you would collect that gain at some point. And the third to think about, although it's against interest for someone who works at a charity as I do, not clear that people should be able to deduct the full fair market value of appreciated stock when they contribute it to charity. You could treat that as a realization event, or you could just limit the deduction to their basis. It's very generous to do more than that. And if you took any of those steps, you could potentially collect some revenue without changing the capital gains rate.
Yeah.
We have another
Good
question.
examples of things that could be done with the current system. I will note, so far as, if they're talking about a step up in basis at date of death versus will we tax the built-in appreciation at date of death, those will have different results, because for some of these assets, the step up in basis at death, the inheritor, the person, is going to hold on to that till their death. And I think some of these assets, you will still never see the appreciation, but so those are different revenue hits on those items there. But again, things that there should be discussion of these items before we jump to a wealth tax, which has a variety of complications to it.
We have another question from Mitch Miller, another attendee. The top 1% of AGI taxpayers pay about 40% of the income tax. If that's not their fair share, what do you think that percentage should be?
I think the way to look at it is also what's their share of total income. It's probably more than 40%. Their share of wealth is something more than that. But all I was just is, I think we need to look at what are appropriate brackets today. Should they end at, 500,000, wherever the current 37% bracket kicks in? Should we look more broadly?
Yeah. So to be clear, their share of income is less than 40%. The system is progressive, and the share of taxes is higher than their share of income. That's definitely true. I would add to Mitch's point that the 50% of people below the median income pay no income tax. They pay some Social Security tax, but they pay no income tax. So, I mean, we do have a pretty progressive system as it is. I think 40% is plenty. I think you could maybe find more effective ways to collect, more efficient rules. But obviously, there are deep value judgments that go along with that. I'm not a philosopher with superior expertise there, but I can tell you incentives matter, and you don't want to go much higher than that, or you're going to see funny things happening in the economy.
Yeah, I agree so far as there should be a maximum rate, but we also need to look at what's in the base. I mean, there's certainly, someone getting a $20,000 healthcare package from their employer because they're a high-paid executive. I'm not sure why people don't even have health insurance or subsidizing that, because that is the largest tax expenditure in our system, which I know we'll get to that in a little bit there. But those things should be looked at.
Okay, and then we have one other question. Okay, there are some questions on the estate and gift tax, which I think we're going to hold off on for a bit. But there's another question from Ed Levine. What is the likelihood of carryover basis replacing step up in basis at death?
So I actually think the fact that it's been in the Biden campaign literature is significant. I think it's going to be on their list of things they try to do. Whether they actually are able to get the votes is a question. But I think that's going to be a live issue. And I will joke and say better to die soon rather than later. But if you want your base to step up. But in all seriousness, I think that one is, you could see some changes.
And I agree. I think it's been on the agenda, and even the wealth tax is still out there being talked about. It's not like, it was someone mentioned at a debate and then it just died out. I think that discussion will be there. And I think if there's also a proposal for, let's actually do mark to market at date of death, there'll be some thought of, we actually like to take, because the rule's already in the law. It's taking section 1015, the gift basis, and saying, we're going to get rid of section 1014. We're going to use the gift basis. So it's already in the law. Some people might think, that's actually a better deal than mark to market at date of death, which also is on the agenda. So I'd be interested to see that discussion. But you do wonder, why has the system been that way? I mean, I'd like to give the example of, I hate to pick on somebody, but Jeff Bezos. I mean, if he was to die today, I mean, he's got billions of dollars of appreciation of stock that would never be subject to any kind of income tax. Now, that might still be the case if his children inherit that and never sell it. But I think we'd say, well, why should he get the tax-free ride if we're going to give somebody a big income tax break? Is there some other group that should be just as worthy? I know I'll hear people say, oh, we're great what Jeff Bezos did. He did all great things for the economy. That's true. But as to why he would be able to escape billions of dollars of income tax, I don't get the rationale for that. But that's where our system's been for a long time. And I think more of the public will start to understand, yeah, that does sound odd.
All right. Well, Annette, or actually David, did you want to talk about the corporate tax rate and where you see that going?
Yeah, so I'm sure everybody remembers we were at 35%. We were the highest in the OECD at that point. That's just federal. Then with the TCJA, we came down to 21%. And now President Biden's campaign literature proposes to bring us halfway back to 28%. I do think that's unlikely. I think Schumer himself talked about 25%. I'm not sure exactly where Manchin is. I think you could see some increase in the corporate tax, probably not up to 28%. I'll just take the opportunity to say I think it's a really bad idea. Why do I think that? Well, first of all, it would be nice to have a bit of thought about how pass-through businesses compare with corporate businesses. And what we have with the corporate tax, obviously, is two taxes. You've got the corporate level tax, currently 21%, and then you've got the capital gains tax, currently 23.8%. And if you aggregate those two, you've got something like 40.5%. It's higher than the 37% top bracket. So corporations are already at a disadvantage. You go higher than that, you're just accelerating the disadvantage. But the other point, the even more important point, is it's pretty easy for corporations to shift profits overseas. One way they do that is by moving economic activity. The other way they do it is through planning. They move their intellectual property and so on. And the thing is, if we were to go to 28% again, we would once again be the highest in the OECD. I was checking this last night. There is, just to give you guys a bit of a sense of what it's like. So the UK is 19, Ireland is 12. But the best way to think about this is add the average state tax, which is 6% in the US. So 28 is really 34, in the same way that 35 used to be 41. So 34. Germany is 30. That's our next closest competitor. Japan would be there. Canada would be 26. The next closest to us would be Portugal at 31.50. And again, the UK 19, Ireland 12, we would lose significant profits. They just wouldn't pay it. They'd find ways not to pay it. Not sure we'd raise a lot of revenue. I think we should think carefully about raising that rate.
Yeah, I mean, I think that's true. I mean, that what ends up happening is people vote with their feet. I mean, I know that's true. We have been discussing with California how wealthier taxpayers are trying to escape the state and leave their residents behind. And so the problem is you want to raise more revenue, but you sort of need to achieve a balance of at what point do you have such a flight of capital anyway that it's not productive. So yeah, those issues definitely need to keep in mind.
And for issues of international competitiveness, necessarily is a concern there. Why I think keeping the rate low, though I agree if they were looking for a quick hit to get a little bit of revenue, 22% might actually be a selling point, and probably not the end of the world. But yeah, I think we need to look at the low rate on that.
I mean, there's so many other issues. There are trade issues and there's the, overall economic issues. And so you have to sort of look at the whole policy much more broadly than just being able to raise a few dollars because, it's seeing the forest through the trees and all that kind of stuff. Anyway, so Annette, did you want to discuss the 15% minimum tax on book income?
Right. So Biden has proposed looking also at for large companies. He's looking at like over $100 million of I think based on revenue, net income, sorry, $100 million of net income. And it was actually an interesting article this month in Fortune from Marty Sullivan with tax analysts he went through and analyzed the top 100 Fortune 100 to see how many would actually owe this. And it'd be looking at comparing their cash tax payments to their net income, but looking at book income with the thought being, hey, some of these companies we hear, they're doing really well in the stock market, their income's up, but maybe look at their tax footnote, it's not what we would expect. So it's looking at getting a 15% from that spread, probably still could use foreign tax credit against that additional tax. I'm not sure how high a priority that's going to be because of the complexity in there. And a few of you might remember that back with the 86 Act, there was part of corporate AMT for the first 4 years, a book tax adjustment where they were looking at financial statement income compared to your taxable income. And part of that went into AMT, but they purposely put that in for only temporary while they looked at something different. I think part of it was, Congress doesn't control GAAP reporting, and is that the best measure? I'm not sure it's going to get a lot of discussion, but I think it is a reminder that, hey, we're looking at your reported profits versus what your tax footnote says. But I think a lot of companies as well, I hope many of them are viewing, I'm a good corporate citizen and maybe we don't want to drop too far below that 21% rate. I mean, you do hear comments like that they don't want to be like the absolute lowest because they know some citizens will say, hey, we don't think you're paying your fair share. I was just reminded of the day listening to a presentation of how in England, Starbucks paid like an extra $20 million, 20 million pounds or something because the public didn't think they were paying enough taxes. So I think they're well aware that the public is also paying attention.
So there are a couple questions here about the Biden proposal to eliminate 1031 exchanges. I don't know, maybe we can have a quick comment. I know we're getting close to the hour and we have a lot of material to cover. So maybe you could just make a quick comment.
Trump administration already cut back 1031. I can't see it being a high priority.
And I would add, since it's really real estate that benefits now, the real estate industry has not had an easy ride the last year. And so if I were a lobbyist trying to make the case for them, I think I would accentuate the utter pain and the fact that they've been absorbing a lot of unpaid rent and all the rest. So I think it feels to me politically as if that one maybe would be lower on the list, but who knows? It's hard to say. It was in his literature. I mean, Biden did say that was something he wanted to do during the campaign.
Okay, and I think at this point, why don't we start talking about some tax expenditures, which I think people really want to hear about. Annette, did you want to comment on COVID relief?
Yes. So a couple of things, reminder what tax expenditures are. And the Joint Committee on Taxation, Office of Management and Budget, Congressional Budget Office at the federal level, they issued these reports. All states also have, like in California, Department of Finance issues an annual tax expenditure report. Why it's called a tax expenditure is that spending can be like a line item in an agency budget, like in the Department of Education, they have money allocated for Pell Grants. Well, there's also in the tax law an American Opportunity Tax Credit, where through the tax law, we will give you $2,500 per each of the first 4 years your child is in college. It's the same spending. That's the same net effect if that was in the Department of Education budget. Hey, you're in college, we're going to give you $2,500 for each of the first 4 years, or it's in the tax system. So they're called tax expenditures. They are provisions that aren't part of a normal tax. I mean, when you designed a personal income tax, you would not put in credits in there. You'd only have a standard deduction, personal exemptions, and you would allow a deduction for the cost of producing the taxable income. And we tend to move far from that. But that's what tax expenditures are. The dollar cost of those at the federal level is approximately what it is in our discretionary spending. So there's a lot of dollars in there. I'd mentioned before, like the exclusion for employer-provided health insurance. That is the largest one. It's $220 billion a year, benefiting roughly 60% of employees who have health insurance. It's the best way you can go to get health insurance, have your employer subsidize it because it's tax-free to you, and everybody else is helping to subsidize that. So these arguably should be looked at. I'm not sure we're doing a very good job of looking at them. Just as an example, along those lines, when a bill is being debated in Congress, the Joint Committee typically will have they have to put together their cost estimates of these, or if there's a revenue raiser, how much is it going to raise? They project it out for 10 years. So, for example, with the COVID legislation, we saw in the CARES Act as an example, the cost of providing the 222 it was the cost of providing 160 million individuals with economic impact payments of $1,200. That was roughly $292 billion. And I think everybody think that's a great way. People needed the money, you could get out, helping the economy, all of that. Also in the CARES Act was a provision to delay the effective date of the business loss limitation at Code Section 461L to postpone it effective date for 3 years. Joint Committee says that benefits 130,000 individuals compared to 160 million who got economic impact payment. The cost of the 461L change was 58% of the cost of the other one. I mean, you could have taken those dollars, which I know is just timing, but the Joint Committee put a dollar amount on it that factored into how much could this bill cost. It could have actually been another 1,060 per individual getting the economic impact payment. Where was the discussion of that? In the Consolidated Appropriations Act recently enacted, there were 33 expiring provisions, plus a few expiring from the CARES Act, which we're used to seeing Congress wait even several months or a year before dealing with those. They all got dealt with in that year-end legislation, including some made permanent. If they were looking for money for economic stimulus, why make some of these provisions that no one expected to be made permanent, some extended 5 years. So we're not really taking a look at the cost, which we really need to be doing. The tax expenditure reports really are kind of a roadmap to, if you need more revenue, what can you cut back or eliminate, including some of these expired provisions that probably just should have expired. They've been renewed for, over a 10-year period. How important are those, particularly when actually 2015, we had members of both parties saying, yeah, we're done. We're phasing out bonus. We're getting rid of some of these credits, but they just never go away. But the tax expenditure reports for both federal and state level really are worth looking at. Ideally, when they also come with a distribution, who is getting the benefits of those items. I think this is where there's revenue when it's needed for doing something like broadening, instead of $220 million benefiting 60% of employees, could those money be spent to better ensure everybody has some level of health care, just as an example?
So can I add just 2 quick points about COVID relief? One is, and that you and I may have a slightly different view on this, but I don't know that we've been as targeted as we could have been. Some of these checks are going to families that didn't lose their jobs and really are in no different position than they were in before. And I gather that spokesperson for the administration yesterday, when asked about a family in Sacramento with $120,000 income, her answer was yes, President Biden wants that family to get the additional checks in the new bill. So I was on a panel with Jack Lew last night, who is the Secretary of the Treasury in the end of the Obama administration. And one of the points he made is that maybe the government doesn't quite have the capacity to target, but I don't know about that. I mean, they've got tax returns from prior years and all that. I wonder. So
they can target it better. They can target it, but even the phase out for the economic impact payment, the more kids you have, the higher income, you're still getting something. You could be well over 200,000 of income. They can change that formula. Also, they could have put some clawbacks or some requirements like, the payroll deferral, which I'm sure most publicly traded companies, UPS is one of the few I saw where they actually put in their 10Q, yes, we got $1 billion of benefit from that. Well, their income's up. They weren't that adversely impacted by COVID. Not to say they didn't have to do extra expenses to get their, keep their employees safe and all that, but you also seeing reports now of companies getting PPP loans that aren't requiring any of these safety protocols. So they're arguably helping to spread coronavirus, but they're getting dollars. Where was the logic of not saying, hey, you got to put these provisions in place if you're going to take this money? We're not necessarily being smart on spending it all.
One other quick thing on COVID relief, which is looking back to the CARES Act. One of the things it did is it let corporations use NOLs going back to the pre-TCJA years. So you could get a 35% benefit from a loss instead of a 21% benefit.
Yes.
And so just worth noting that yesterday, 100 Democrats, I think it was Representative Doggett from Texas was maybe the sponsor of this, but 100 Democrats proposed to add to the new legislation a bill repealing that. So even though you have people who file, corporations have filed hundreds of millions of dollars of returns probably on that basis, they'd like as part of the new legislation to undo that. Now, my guess is that's not going to happen, but I just wanted to flag it for anyone who might be interested.
And if it wasn't already full employment for tax practitioners, that will increase the need for them.
Yes, I agree. And David, did you want to comment on the retirement 26% credit?
Yeah, so one of the things in the Biden campaign literature is the observation that 401ks and IRAs are sort of more beneficial to people with higher incomes. And I guess what they're talking about is that a deduction is a function of your marginal rate. So they're basically suggesting that it would be a credit instead. They didn't use a number, but Brookings Institute did a calculation and said, well, if you wanted something revenue neutral and you wanted to change 401ks and IRAs to have an equal per dollar benefit for everyone, what would you do? And that would be a 26% credit, not refundable. In other words, if you didn't have income, you wouldn't collect this, but anyone who did could get a 26% benefit. Now, one thing to observe is mathematically, the Roth IRA does for you everything that a deductible IRA would do. Now, a Roth IRA, I shouldn't talk about, that's sort of limited in terms of income levels, but lots of 401ks and 403bs offer a Roth option. So if Congress was to do this, and therefore effectively make the deductible version of a 401k less valuable to high income people, presumably they would just do the Roth instead. This was my exam question in basic tax just a few weeks ago, as a matter of fact.
All right. And then, Annette, another topic I think people want to hear about is worker classification in the gig economy. And I think you were mentioning that it's possible that the federal government might look toward the ABC test in Dynamex.
Yes, the Democratic platform actually suggests they want to look at the ABC classification scheme, I think, for all federal laws, tax, Fair Labor Standards Act, Labor Relations Board, and all of that type of rules. So we're already experiencing that with California because that went into effect January 1st of 2020, the ABC classification test, where basically you start at the presumption a worker is an employee unless you can show they meet A, B, and C. A is pretty much the common law control test. B is they got to be doing some kind of work different than what you do, like the plumber coming out to the law firm. Yes, that's fine. You're going to meet the B test, but hiring a contractor lawyer to help you with some project probably isn't going to meet the B test. And then C is proof that they really are engaged in their own business, right? They got business cards, website, customers, and things like that. In California, when that was put in place, also it first came with 50 exceptions, roughly 50, which means if you meet an exception, such as you are a attorney or a CPA who has got license in California and practicing, then that way you would meet an exception, which means the old law applies to you, which is pretty much called the Borello factor, is pretty much the common law approach there. This past legislative season, they modified all that with AB 2257, which actually, one, made it clear this classification also applies for California income tax purposes, and they added a bunch more exemptions. Now we have over 100 exceptions where if you meet the exception, you're going to apply the old common law standard. There were people lined up to get even more exceptions this legislative season, but the challenge, I'm not sure many people would be too concerned about the A and the C part of the test, because A pretty much is the common law control, and C is, yeah, if someone's a contractor, they should have other customers. You shouldn't be their only gig around there. But B can have an impact on who your customers are. I have an issue now at the university of trying to hire somebody who's clearly in business for themselves. I've hired them in the past. They come lead a workshop. Now they lead a workshop on etiquette and all of that. I don't believe that person is going to meet an exception, but they're teaching students. That's what we do at the university. I don't think they'd meet the B test. Now, someone said, well, how come they don't line up to get an exception? I said, I think they're too polite to ask. That's a joke. But why should that be affecting who your client base can be? So I think the B part is really out of touch. Now, it will impact, it's not just for gig workers. This is any kind of a contractor. This is a new classification system in California, which they are looking at the federal level as well. And now the Democratic platform also says they want to promote entrepreneurship. There is a conflict between those two approaches there. Mm-hmm. Often the worker classification issue, when it's coming up, includes a main concern of some of these workers not getting safety net benefits. Some of them also are getting net pay that's below minimum wage. There's no doubt that needs to be looked at. That doesn't warrant a new classification system. That warrants improving the safety net benefits and changing the worker classification. Like, why can't the common law also say, hey, if you're not paying that person at least 200% of minimum wage, they're an employee? I mean, that would be one way that these things can be dealt with. And we should be looking at these safety net provisions. Why can't they be available to all? And in California, Prop 22 included that the gig drivers would be protected by discrimination laws. Why isn't everybody protected by those? The CARES Act extended safety net benefits to self-employed. They were able to get a PPP loan even without employees. They were eligible for unemployment. They were eligible for the payroll tax deferral, and they were eligible for an equivalent of the paid family and sick leave. So we know how to do it. I would say that's the discussion that we need, but watch out for this. It will drastically change what the workforce looks like. Also, I spent a lot of time, as does David, with Gen Z. I don't think they're going to be too happy with it. I remember seeing a flyer many months ago on campus for students. Oh, want to be a freelancer? Come to this workshop. And I said, I don't think the lawmakers have seen that flyer, because they'd be like, no, we don't want you to be a freelancer. We want you to be an employee.
Yeah, it creates a lot of problems, both for people trying to have these kind of part-time jobs and companies that can't really afford to have employees. And
and not reflecting how we live and do business today, because
yes,
many of these people who are doing like the gig work, and again, these rules apply beyond gig, but many people getting to gig work, they are looking for, I need quick money, and they get on, they're working part-time, and they are not going to be doing this for more than 6 months. Now,
right, for the most
they're not going to
part,
get hired as an employee to work 5 hours a week for 6 months. They are out.
Right. So we hardly have any time left, but David, and this has been really great. Thank you so much. If you can just maybe have a couple comments on family credits, and then I think we need to wrap it up. I know someone keeps asking about if you see the likelihood of a reduction in the estate tax. But why don't we just focus on family credits, and then I think, I'm not sure we really have time to get, we have about 1 to 2 minutes left.
So the Biden administration has said that the campaign said they wanted to reduce those credits down to something like $3.5 million a person, I think it was. We'll see whether they have the votes or they really want to pursue that. They absolutely, in their campaign literature, had a number of different family credits. So the dependent care credit, which we already have, they want to increase the expenses from $3,000 to $8,000, and reimbursable portion 35% to 50%. They want to grow that child tax credit, separate credit. It's now $2,000. They want to make it $3,000. But if your child is under 6, then you get an extra $600. So go have children, I guess. They want to reestablish the old first-time home buyers credit. There's a renter's credit they're proposing. And they're even also talking about some forgiveness of student debt. So there's a bunch of stuff there.
All right. And this question has been asked a couple times. This is important, Annette, about the employee issue classification. What kind of impact do you think it'll have on loan out companies in the entertainment industry, which I know is a big issue with that?
Yeah, that's a good question. It really does change some issues, as well as the challenge of, well, what am I in better situation if I actually form my own LLC? But it is looking at, how would you interact with the payor in fact and in contract? So if they really are being hired directly by the employer, as opposed to them hiring your LLC or loan out corporation, I think you've got you've got issues there. But again, why are we going through all these, special maneuvers to get a different result when I think overall, people want protections for all types of workers. I think overall we want to promote entrepreneurship. If someone wants to be employee, we want to promote, healthy employment relationships there. Let me make just a quick point, on the first-time homebuyer credit. It's just also a reminder there's opportunities where certain things just make more sense. Today, less than 11% of individuals itemize, and not all of them have a mortgage. So this is probably the opportunity. And will they look at this strategy? Is this the time to say, well, maybe get rid of the mortgage interest deduction and put in a first-time homebuyer credit? There's plenty of research out there that shows the mortgage interest deduction does not increase home ownership. It really just helps higher income buy a more expensive home. But there's a lot of data out there, a lot of research from think tanks, Congress, academics. Hopefully it'll all be looked at, and we'll have good policy discussions to get, a good policy, a good tax system from any kind of reform going on.
Okay, and do either one of you want to comment on the likelihood of a reduction in the estate tax exemption of 11.7 million?
I know David just mentioned, I can't be as a high priority because it's going to get dropped by 2026 anyway.
Right, that makes sense. All right, well, we're actually over time, so I want to thank our panelists. Thank you very much. Really appreciate your coming to Beverly Hills from far away. It's been great to have you here, and everyone out there, thank you for attending. If you are interested in becoming more involved in the tax section, please reach out to me. I would love to hear from you, and wish everybody a great day. Thank you so much. Take care. Bye-bye.
Great. Thank you.
Thank you. Bye.